This week, the market had a full-blown personality crisis. Monday, the Dow dropped over 600 points. Tuesday, it bounced back super hard. Wednesday, Nvidia reported the biggest earnings in its history. And then Thursday and Friday, the market sold off anyway, with the Dow dropping another 800 points today on hot inflation data. So if you are confused right now, trust me, you are not alone. Wall Street this week could not make up its mind, okay? I'm Dominique Broadway, your host and your guide through all of this mess. Welcome back to Beat the Bell. Let's get into it, all right? So let me paint the full picture of this week, because every single day told a completely different story. Monday, we can just call it Bloody Monday. The week opened super rough, y'all. The Dow dropped over 600 points. Two main reasons. First, December's core PCE inflation, that's the Fed's preferred inflation gauge, came in at 3.0%, hotter than expected. The Fed's target is 2%, so that gap actually matters. Second, we had fears around a whole proposed 15% global tariff policy, which had investors in full panic mode about rising costs and slowing growth. Tuesday, we call that turnaround Tuesday, the ADP jobs report dropped and private employers added 195,000 jobs in February, blowing past the 145,000 estimate. And then the consumer confidence also ticked up 91.2%. Okay, so the market said, okay, maybe the economy isn't falling apart. And then the S&P snapped back and erased Monday's losses by midday. So it looked like the week was actually turning a corner. Then on Wednesday, earnings took the whole center stage, okay? So Nvidia and Snowflake both reported after the closing bell. Big numbers, some drama, and we'll get into both in detail in just a minute. Then Thursday and Friday, the whole reversal. Here's where the week took its final twist, okay? So despite Nvidia's historic earnings, the stock dropped 5.5% Thursday and is down again on Friday. Also, the fresh wholesale inflation data came in way higher than expected this morning, and then growing skepticism about whether AI infrastructure spending can be sustained sent tech stocks lower for a second straight day. So now the S&P is sitting around 68.56 or so, down nearly 1%, and the Dow is off another 800 points, and the NASDAQ is down like over 1% on the week, okay? So the picture at the end of the week looks very, very, very different from how it looked Monday and Tuesday afternoon. And that is exactly the lesson that we are going to unpack today, okay? So first, let's talk about Nvidia. So Nvidia dropped historic numbers. And despite that, on Wednesday after the bell, Nvidia reported fiscal fourth quarter results, and the numbers were genuinely historic. Revenue came in at $68.1 billion, up 73% from a year ago. Earnings per share hit $1.62, beating estimates of $1.53. Their data center business brought in $62.3 billion, y'all, up 75% year over year. For the full fiscal year, $159 billion basically in revenue. Absolutely insane, okay? And they guided to $78 billion for the next quarter. That is an extraordinary business by any measure, okay? So why did the stock fall 5.5% Thursday and continue to slide on Friday? Two reasons. First, the guidance, okay? So while the guidance was strong, it wasn't enough to wow a market that had already priced in perfection. So when expectations are honestly already sky high, even beating them can disappoint. Second, Nvidia stated it is not counting on any data center revenue from China in its next quarter forecast. So that China exclusion spooked investors who were honestly already hoping for like a broader global demand story. So here's what I want you to understand. Nvidia is the infrastructure company of the AI economy. So every major tech giant, Amazon, Google, Meta, Microsoft, they all are spending hundreds of billions to build AI data centers, and Nvidia is selling the picks and shovels to do it. Combined capital spending from just those four companies could approach $700 billion this calendar year. So Nvidia captures a massive, massive chunk of that, all right? And the business is honestly exceptional. But here's the lesson, and I'll say it plainly. A great company and a great stock price are two different conversations. The stock drop because it had already run up in anticipation of great news. So that gap between business quality and valuation is something every investor honestly needs to understand. So what this means for your money: if you have broad tech exposure through ETFs like QQQ or SPY, you're already participating in Nvidia's story. But if you're thinking about buying individual stock, the question is not whether Nvidia is great business. No, because it clearly is. The question is whether everything good is already baked into the price, right? So you need to know which question you're actually answering before you make that next move. All right. Now let's jump into Snowflake really quickly. So Snowflake had a beat that still punished investors. Okay. So Snowflake also reported on Wednesday after the bell, and they beat on both top and bottom line. So revenue came in around $1.28 billion. Okay. Up about 31% year over year. Earnings per share of 32 cents, beating the estimate of 27 cents. Solid beat, right? And yet the stock has fallen nearly 20% actually over the prior month and sits around 23% or so lower year to date. Why? Because despite that revenue growth, Snowflake posted a net loss of over $300 million in the quarter on a GAAP basis. And to pile on, multiple securities class action lawsuits were filed against the company the same day as the earnings, related to how they disclose the impact of certain product efficiency features on like their revenue or whatever. But essentially they beat the estimates, but the stock still gets punished. That brings me directly to today's teachable moment, because this exact scenario plays out in the market way more often than people will even realize, and I want you to be prepared for it. Okay. So revenue is not profit. Revenue is not profit. This is one of the most important distinctions that I can teach you. And Snowflake just handed us the perfect classroom example. Okay. Revenue is not the same as profit. Think about it this way. Imagine you run a catering business. Okay. And you brought in $50,000 in orders last month. That sounds incredible, right? It does. But it costs you $48,000 to operate: staff, food, equipment, marketing. Your actual profit left over is only $2,000. So your revenue was impressive, 50K or so, right? But your profit, not so much. Snowflake is doing $1.28 billion in revenue per quarter. That is super impressive. But they are spending so much to run and grow that business that they lost over $300 million in a single quarter on a GAAP basis. Now, let me explain that term. GAAP, or GAAP, stands for Generally Accepted Accounting Principles. It is the standardized, no tricks way to look at a company's real financial picture. So a lot of growth stage tech companies will show you a different number called non-GAAP earnings, which strips out things like stock-based compensation and certain one-time expenses to make the picture just look cleaner. Okay. So Snowflake's non-GAAP earnings per share of 32 cents sounded great. The GAAP reality was a $300 million loss in a single quarter. Okay. So both numbers are disclosed, but not everyone knows to look for both. And that gap is where investors get caught off guard. So before you buy any individual stock, ask yourself 3 questions. 1, is this company actually growing? Okay. Look at the revenue trend over several quarters. Number 2, is it actually making money? Look at the GAAP profit or loss, not just the adjusted number. Number 3, if it's not profitable yet, what is the concrete path to get there, and when? When is this going to happen? Okay. And the last question is exactly what the market is demanding from Snowflake right now. You're growing 30% a year, but when do you actually turn a profit? So when that answer isn't clear, the stock gets punished even on a beat. Okay. So numbers on a press release do not tell the whole story. Knowing which numbers actually matter is what separates informed investors from everyone else. All right. So outside of earnings, 3 major stories this week directly affect your personal finances as well. So here's the quick download. Number 1, the Supreme Court and tariffs. All right. So midweek, the Supreme Court temporarily struck down sweeping import tariffs, which gave markets a brief little boost. But the administration has already signaled a quote unquote plan B of 15% global tariff floor is still on the table. Okay. And then today's wholesale inflation data is a reminder of what tariff driven cost pressures actually look like in practice. So tariffs function like a hidden tax on goods. If broad tariffs return, expect prices to rise again on electronics, clothing, and groceries. And companies like Procter & Gamble, are already signaling mid single digit price hikes on a lot of their different products, okay? So make sure your budget has cushion for that possibility later this year. Number two, the GDP came in weak and rate cuts just got pushed even further out. So fourth quarter 2025 GDP came in at only 1.4% growth, which is well below the 3.8 to 4.4% we saw in prior quarters. So a significant part of that slowdown was the government shutdown. But consumer spending is genuinely softening. In today's PPI data, wholesale inflation came in at 0.5% versus the 0.3% that was expected, with core PPI surging 0.8% against a 0.3 forecast. Pours cold water on any hopes of any near-term rate relief. So markets are now pricing in the first rate cut until July at the absolute earliest. So if you've been waiting to refinance your mortgage, take out a home equity line, or loan, or make a major purchase relying on rates coming down soon, adjust your timeline because it's getting pushed further out. So that relief is further away than it looked just a few weeks ago. Okay. Number three, consumer confidence ticked up, but watch the fine print. Consumer confidence rose to 91.2 this month, slightly better than expected. And that is a green flag, okay? But the forward-looking expectation index is still sitting below 80. So historically, readings below 80 for extended periods have signaled a recession risk on the horizon. And this is now the 13th consecutive month below that threshold. So people feel okay about like right now, but honestly, they are nervous about what is coming. So use that awareness, make sure your emergency fund is in good shape, your debt is manageable, and that you are not carrying more investment risk than you can actually stomach in like a super volatile environment. So two quick things before I let you go. If this week's conversation about earnings, stock movements, and reading the market has you curious at all about how to use options as a tool to generate income to protect your portfolio or both, I have a options masterclass coming up and I want you there, okay? I'm gonna drop the link in the show notes. It is absolutely free. And if you are looking for a community of people on the same journey of building wealth from the ground up, having honest money conversations without any judgment whatsoever, that is exactly what the Demystified Collective is. It's only $1 to start, and it's for first generation wealth builders just like you, just doing the work together. So the link will be in the show notes for that too. This week was a true masterclass on why we do not make emotional decisions based on any single day's headlines. Monday looked like disaster. Tuesday looked like recovery. Friday looks like a sell-off again. The investors who win are the ones who stay informed, stay grounded, and keep their eyes on the long game. If this episode added value, share it with one person in your life who needs to hear it. Until next time, stay informed, stay intentional, and always beat the bell. See you soon.